is given over here. So, what are you going to cover today? Today we are going to cover very important two case studies. Two case studies related to derivatives, the most difficult part in your BFM, the most difficult part. That's why watch the video till the end. Share it with your friends. Share it on all your social media platforms. Like the channel, subscribe to the channel. Click on the bell icon. Okay? Because you will be getting many YT series now, many marathons now for CAIIB in this month. So don't miss it. Okay? So let's start with the session. Which of the following liabilities are not excluded from the CRR calculations? Understand the question. Which of the following liabilities are not excluded? It's not excluded. They are not asking which are excluded. They are asking which are not excluded. Not excluded. Okay, from the CRR calculations. Paid up capital, refinance from CAIIB, claims from DICGC and overseas borrowing. Not excluded. What is CRR basically? How is CRR calculated? CRR is calculated on the basis of NDTL. NDTL, net demand and term liabilities, right? Demand and term liabilities. So, these liabilities are related to mainly from the customer angle only. Liabilities from the customer or from the other institutions. Okay, customers which are a part of your banking business. Here, understand this. Which are a part of your banking business. Okay, other banks, loans, all these. So what do we include in this demand and term liabilities over here then? Paid up capital. Is it a part of demand and term liabilities? Let's see one by one. Paid up capital. Is it a part of demand and time liabilities? Term, yeah. Paid up capital is a part of capital part, tier 1 capital. This is the part of tier 1. This is not the part of your business. Paid up capital is not the part of your business. Okay? It's a part of your capital. So that's why this will never be included in your CRR calculations. Got it? Because in CRR, what do we include? What is my business? Regular business. My regular business is what? Taking the deposits, giving the loans. So that will be included. Here we are talking of deposits only because liabilities. Here I'll talk of this saving current CASA and term FDs. Plus, what are other liabilities? In the course of business, I may take the liabilities like this. Here, what are the main liabilities of any bank? Liabilities. What are the main liabilities of any bank? One, CASA. Second, FD or term deposit we call it. Third is borrowings. Bank will also borrow. Okay, bank will also borrow from various institutions. That will be the part of your this borrowings part because that's the liability. But that should be the part of your business. That's important. Okay. So coming back to this point, paid up capital, tier 1 capital. Similarly, reserves and surplus, here there are 2-3 parts. Net profit, reserves and surplus, R&S, revaluation reserves. Let me remove all these. See this net profit, reserves and surplus, R&S, revaluation reserves, reval reserves we call it. These are a part of your tier 1 capital. So these are not included in your CRR calculations. Similarly, refinance from CAIIB. Is this your business? Getting refinance from CAIIB is your business? No. Okay. So, which are not excluded, it's mentioned. Huh? So they are included. Understand these wordings. Not excluded means included. Okay. Which of the following are not excluded from the CRR calculations? So this is not excluded. Then second, refinance from CAIIB. This is not your regular business. Okay. So this will also be not excluded. So it will be included. Okay. This will also be included in this. Then claims from DSCGC. This will also be included. Okay. Not excluded here means included. But overseas borrowing. Okay. So this will be not excluded from this. So this is not excluded, means this is included. And these all are not included. These all are not included. Not included. Okay. Paid up capital is not included in CRR calculations. Refinance from CAIIB is not included in CRR calculations. Claims for DSCGC is not included in your CRR calculations. Why? Because these are not your regular course of business. That is not your business. To get a refinance from CAIIB or this claims from DSCGC, this is not your regular business. So that is not included. But what is included? This overseas borrowing. Because this is a regular course of business. This is what you do. You get the loans from somebody and give the loans over here. Means what do you mean by this overseas borrowings? Here we mean ECB, external commercial borrowing. ECB, kindly note. In ECB, what do we do? The bank takes the loans or gets the funds from some other bank in US at a lower rate of interest. US or any country at a lower rate of interest. Okay. So this ECB is at roughly around 2.53%. They take the funds and then lend it over here to our companies at higher rate, 7.5. Corporate finance is at around 7%. So get a margin of around 4.5% roughly. Okay, so this is included because this is your business. Okay, got it? Everyone clear? NPA is a loan or an advance. Where? So what is an NPA? Interest or installment of the principal remain overdue for more than 45 days in respect of term loan. Interest or installment remain overdue for more than 45 days in respect of term loan. The account remains out of order in respect of an overdraft cash CC, means overdraft cash credit CC. The bill remains overdue for more than 45 days in case of bills purchased and discounted. The installment of the principal or interest thereon remains overdue for 2 crop seasons for long duration crops, long and 2 crop seasons. Now this is a simple one. Every one of you must get it. Show me in the comment section. Let me see in the comment section. Yes, very simple one. The answer is here. This answer is not correct. 45 days. The rule is 90 days. 90. Okay. Everywhere the rule is 90 days. Okay. The rule is 90 days. Everywhere. Then 45 days over here. Again 90 days. So that is also out. In long duration crops, the period is 1 crop season, not 2. So this is 1 long duration crop. It is 1 crop season. Now many of you might be asking, sir, how do we know we are bankers? Which is 1 crop, which is 2 crop, which is long, which is short? I don't know. In that case, what do we do? In that case, the list is given to you by the bank. It comes from RBI and various institutions. So you need not worry about it. Okay? Work as per the list. Don't apply your own brains. So the correct answer is over here. Out of order in respect of overdraft CC. If any account remains out of order constantly. What is out of order? Out of order means, suppose if I have sanctioned a CC of let's say 1 lakh rupees. Okay, and that account constantly moves, means that account is constantly above 1 lakh. So it is generally, the average balance is around 1 lakh 1000 constantly for all the 3 months. Then this is called as out of order. When any account is out of order constantly for 90 days, it is called as NP. Okay. It not only depends on the sanction amount, but also on the DP calculations. If it goes beyond your DP, then also it's called as out of order. Okay, got it? So the correct answer is this. And the correct answers for these are also, kindly note, 90 days. These are the correct answers. Now I told you we'll be solving some numericals. Very important ones. Because these will give you the idea. These will clarify your doubts in the minds, which are very useful in the exams also. Very, very useful. It will clarify the doubts regarding options, futures, derivatives. See this, first one. An investor enters into a short gold futures. Short, understand this word short. I have taken this many times. Short means short gold futures. Okay. When the future price is 60 cent per pound. 60 cent per pound. Now see this. This is mentioned as gold. You can take it as dollar also. Anything. Commodity is a commodity. It can be gold, it can be dollar, it can be stocks, it can be anything. So this commodity is not important. The transaction is important. Okay. So 60 cent per pound. One contract is delivery of 60,000 pounds. So one contract is of 60,000 pounds. How much the investor will gain or lose if the gold price at the end of the contract is 58.2 cents per pound and second 61.3 cents per pound. So two cases are given over here. In exam you will be getting these two cases separately. Of course, in exam they won't be giving you as gold, they will be giving you as dollar. But after all, it's one and the same thing. Okay. So 60 cent per pound future prices and one contract for delivery is this 60,000 pound. Means if you have to purchase one contract, you have to invest this much. Okay. And now the rate goes to 58.20. Then what happens in this case? Now I'll explain you. Sir, I won't ask the answer from you. I'll be explaining you the case today because I know many of us are not into this daily business of options and futures, right? We don't know that much. So that's why I'll be explaining you the case. Let's take the first case. In case of pound 58.2, means first case is of 58.2, second case is of 61.3. Okay. So in case of pound 58.2, investor is obligated to sell, say this, enter into a short gold futures. Okay, short gold. Now here, investor is obligated to sell 60 cents per pound, something that is worth 58.2 cents. Now what do I mean by this? Per pound. Okay, so there is a gain to the investor per pound. So there is a gain to the investor of 0.6 minus this much, 0.5820 and into 60,000. Means what? What is all these calculations? See, a rate is very simple. This 58.2 cents, when we call 58.2 cent, now see this, I'll call it rupees, okay, call it simple. This is, let's say, because cent is also a term used in your BFM. Let's say call this paise and let's say call this rupees. Okay, rupees. Wherever we have pound, call it rupees. Wherever we have cents, call it paise. So investor is obligated to sell 60 paise per rupees, right? Paise per rupees. Okay. Something that is worth 58.2 paise. So what does it mean? This 58.2 you'll have to divide it by 100 because we are talking of paise and rupees now. We are converting this paise to rupees. So we'll divide this by 100. So it is 0.58. So 0.58 I have taken over here. What is the present price? He has entered into what? See, a rates given initially 60 cent per pound means 60 paise per rupees. Okay. So this now, what is the difference in this? 60.6. So 60 means 0.6. 0.6 minus 0.58 into 60,000 because total net amount invested is 60,000. So 0.6 minus 0.5820 into 60,000 equals to 1080 rupees. So there is a gain to the investor. Investor will gain in this. Investor will gain. So if I have entered into this contract, there will be a gain for me. Why? Because I have entered into the contract to short gold futures. Short. Okay. Means I have sold it first, then I will be buying. If the price goes down, here I have very simple logic I will give you. I have sold it at 60 and now the gold price is at 58.2. Right? Simple logic. I have sold it at 60. Now the gold price is at 58.2. So what will happen? I have sold at 60, 58.2. Difference is what? 1.8, right? Into this much amount, 60,000, whatever it is. So you just see this multiplication. 1080, 1.80. So you'll just multiply it. You'll get the same answer. Right? So it's simple calculation. What rate I have sold, what rate I am purchasing. Now second case is also a similar one. Now the price is 61.3. So I have sold at 60. I have shorted. Shorted means what here? It's given short. This short. What do you mean by this word short? Short means sell first. Here, understand this word short. Short means sell first. Sell first. And then buy later. That is short. Long means what? Long. Long means buy first. Buy first. Okay? Long means buy first. Sell means, short means sell first. So here, I have sold it at 60. So sold at, let's say what is the rate? 60. And buying at what? Now the price has increased. In second case, the price has increased, 61.3. So subtract it, 1.3, right? 1.3 into this 60. Do the calculation, see this, 1.3 into 60. Do the calculations, 78. Okay, this will be the answer, 780. We'll have to do this points, subtract this adjustments, and the answer is 780. Isn't it? Simple logic is at what rate do I buy and what rate do I sell? Got it? So 0.6130 minus 0.6. If you subtract it, divide it by 100 because this is cents and this is pounds, or this is paise and this is rupees. So divide it by 100 and multiply it with 60,000. So zeros will go and this remains, whatever remains is this 780. Okay? Got it everyone? Clear? Simple calculation is buy at what rate, sell at what rate, and that's the difference. Next one, second one. Suppose an investor writes a put. See this, writes a put. Now understand this word. Writes the put. What is writing of the put? Kindly understand one point. Whenever you buy the put, buy. There are two things. One is buying and second is selling. Selling. Whenever you are buying the put, buy. Buy the put. It means what are you doing? What are you doing? So whenever you buy the put, you gain when the market goes down. Whenever you buy the put, you gain. Your profit is when the market goes down. Market is or rate is down. Market down means rate is down. Whenever you sell the put, okay, sell the put, and then the market is down. Market down. Then you will lose, loss. You will have a loss. Kindly note. Okay. So buyer of the put option will always have gains when the market goes down. Reverse is also true. Now, if I speak of this, discuss the same thing about call option. Call is similar one. In call, what happens? Call. So buyer will profit when the market is up. Okay. And here call, if I sell the call. Sell the call. Okay, the seller will profit here. Here we are talking of seller. Here we are talking of buyer. Seller will profit when the market is down. Kindly note this basic logic in call and put option. Seller of an option or seller of any derivative, okay, will profit when you have these scenarios. Mainly put and call. Seller of the put will benefit when the market is down. Buyer of the put, will benefit when the market is up. Buyer of the put will benefit when the market is down. Kindly keep this table handy for you. Handy. You must understand the basics of call and put. When will the buyer of the put benefit? When will be the seller of the put benefit? Now, seller means what? Writing the put means selling the put. Writing means selling. Understand this word. Whenever you get the word write the put, it means you are seller of that put. So, you are in this category. Okay? Suppose if I say, okay, now in the comment section, let me see. I am writing the call. So, who am I? I am seller of the call or I am buyer of the call? You answer me. I am writing the call. So, who am I? Am I seller of the call or buyer of the call? In the comment section, everyone. Am I seller of the call or am I buyer of the call? Comments. Let me see. I am seller of the call. Okay, seller. Okay. When will I benefit? I am writing the call. When will I benefit? See this table. When will I benefit? I'll benefit when the market is down or the rate goes down. Market down means rate down. Okay. So now let's look at the question. Suppose an investor writes a put. See here we are in this case. Writes the put. Here we are. Okay. So market is down. The investor will benefit. Profit. Okay. Loss. Market is down. The investor will make a loss. Right. In this case we are. And if market is up, the seller will always make the profit. Okay. This case we are. On a built company stock. Now, built company means what? It's the name of some company. You can take it Infosys also. Infosys company stock. Okay. With a strike price of 50. So, strike price of 50. So, this person is writing the put. Means selling the put at the strike price of 50. Now, what does it mean? I'll explain you. Okay. But never forget this logic. Because everything depends on this logic. Okay, and expiration date is 3 months. The current price of the built stock is 51. So he has written at 50, he has sold it at 50. And now the price is 51. What do you committed to yourself? Means suppose if you are the seller, what have you committed to that? Means if I am the seller, okay, so I am this investor. What have I committed? What have I told the person in front? I am the seller means there is a buyer. So what have I told this buyer? How much could you gain or lose? So how much can I gain or lose in this case? Now strike price is 50 and this current market price is 51. I am the seller of this call. Or what? Put. Okay, seller of this put. So remember this table. Let's move to the explanations. Here this also I will explain you. I won't ask you the question over here, right? I'll explain you. See here, read this properly. You have sold the put option, sold. Okay, you have sold the put option. You have agreed to buy. See here, sold the put option means what? You have agreed to buy 100 built shares for 50 per share. So whenever you are selling, you mean that, what do you mean by that? That this share price will not go below 50. It means that whenever I sell the put at 50, it means I am telling that further the person next to me that this share price will not go below 50. So it means what? I will be buying it at 50. At any cost, I will be buying it at 50. Because I believe this will never go at less than 50. अगर 50 से नीचे गया तो मैं लूंगा, चलो 50 के भाव पे मैं लूंगा. That's what I'm telling this person, whoever is a buyer. So I'm agreeing to buy the 100 build shares at 50. If the party on the other side charges to exercise, means if there is a buyer, let's say I sell this and there is a buyer. Now this buyer, when will this buyer gain? Understand this clear logic. When will this buyer gain? This table is very important. I am seller of the put. When will I gain? When the market is up. When the market is up, I'll gain. I'll make the profit. Okay, I will make the profit. If I will make the profit when the market is up, it means what? Here, it's a 2% theory. 2% gain theory, we call it. It means if I make the profit, the other person will make the loss. Simple rule is this. So here what will happen? If this market price goes down, okay, goes down. So in that case, who will make the profit? Market price is going down, I will make the loss, so second person will make the profit. If the market price goes up, I will make the profit and this other person will make the loss. Okay, so that is the basic logic of put option. That's why I said this table is the most important table for you throughout your life. Those who are dealing in call and put options in your daily life also. Very important table. Okay. So, you have agreed to buy 100 build shares for 50 per share. If the party on the other side charged to exercise, means they work on it, they buy it. The option will only be exercised by the counterparty if the price of the build share is below 50. If the share price goes to, let's say, 30, see this, suppose the party exercises when the price is 30. Means I said that the share price will not go below 50. I will buy at 50. And now what happens? The share price goes to 30. It has gone to 30. From 50 it has gone to 30. So what am I? I am the loser. See this. You have to buy it at 50 because I told you 50 के नीचे नहीं जाएगा. मैं लूंगा 50 पे. गया 30 पे गया 30 पे गया. Now you buy at 50. You had told me ना, that buyer will say, you had told me ना, नहीं जाएगा, ये लो 50 पे buy करो. So I will have to buy this stock at 50 when the actual price is only 30. Okay, so the loss to the writer, see this, investor or writer will be 20 per share, isn't it? 20 is a loss, and whatever is this amount, whatever is the number of shares, is there given how many shares? No, no. If they give you some 2000 shares, say this example is taken, or 2000, 20 per share, or let's say 100, is it given? 100 is given. This 100. So 20 into 100, that much will be my loss. So 200 rupees will be my, 2000 rupees will be my loss, isn't it? So understand the concept of buying the put and selling the put. Okay. The worst can happen is that the price of the build company will decline to 0. Can happen. Kingfisher Airlines. You saw it. Kingfisher Airlines. Vijay Mallya. You saw it. Down 0. If somebody had purchased this put and sold this put at that time, huge loss. Isn't it? So if it goes to 0, what will happen if it goes to 0? Complete loss of mine. 50 rupees. And then 0, 50 into 100, 5000 will be the loss in this case. See this, 5000, complete loss, right? So this is the basic logic of call and put options. Everyone must understand this call and put options concept very clearly. Okay? This is what was my main concern of discussion today. Because I wanted you to understand this call and put market. This table is the most important table for you in your BFM, in your derivative segment. Most important. Don't miss it. Got it? So this table is the most important table. Now importantly, I'll tell you, many times such difficult numericals are not asked in derivatives. They test your basics. Many times they test your basics. The basics are these. Call option is for purchase, buying. Put option is for selling. These basics are asked because many of the students don't know what is call and put. Okay. So if you remember this, it's the best. But if you don't remember, at least remember this part. Call is for buying, put is for selling. Okay. So now before going, let me show you the new batches. Kindly join the batches through the app. Download the app first. Okay. Go to, the app is available on both iOS as well as Android. So go to Adda 24/7. Okay. Click on, directly on the front page only, you will get it. See this. Crash courses. Now we are coming up with the PYQ sessions also. PYQ sessions. Click on CAIIB. See this. Click on CAIIB, JIB and CAIIB. Click on CAIIB June 25. See this. All the new batches, you will see them. Okay. Increment Mahapack. That is also available. In Increment Mahapack, you are getting physical books as well as the e-books. In Mahapack, you are getting again. See, in both these Mahapacks, you are getting 15 plus batches per subject. 15 plus. Okay, plus ebooks, test series, that is obviously there. These are the new batches. See this. PYQ batches are coming up. Bilingual as well as English medium. These batches you can join immediately. See, the batches are starting from 17th May. Okay. PYQ, previous year questions, case studies and MCQs. Very fast. Okay. Join this ASAP. Ebooks are available, online live classes are available, and immediate, remember, these are the